Hello, and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. Every year brings its own share of financial headlines, but this one has been especially eventful. We've had tariffs making waves, inflation pushing higher, and plenty of market volatility, and that's just this year alone. For many people who are nearing retirement or already living it, an environment like this naturally nudges them toward a more conservative investment approach. And honestly, that response makes sense. Your savings may be needed to support you for decades. You've spent a lifetime building that nest egg, and wanting to protect it isn't just understandable, it's human. During the show today, we're going to take many of our facts and details from a recent Kiplinger article, Why Playing It Safe in Retirement is a Big Risk. That instinct to protect what you've worked so hard for is a big reason why many conservative portfolio strategies exist, including the classic 40% stocks and 60% fixed income mix. It's also part of why annuity sales have surged, hitting nearly $120 billion in just the third quarter. At the end of the day, most people share the same concerns. They don't want to outlive their money, and they don't want to lie awake worrying about the latest twist or turn in the markets. And I'll tell you, even my calculator feels the stress. I asked it how it was handling all the recent volatility, and it said it just couldn't count on anything anymore. That may be a groaner of a joke, but the truth behind it is real. Volatility gets people's attention, and for many, it raises concerns about how to navigate retirement safely. Being too conservative can actually cause more harm than good, even in rocky markets. We've seen this many times before. Think back to the Great Recession, the early days of the pandemic, or the bear market in 2022. In each of those cases, many investors panicked, moved to cash, and then missed out on the recoveries and the bull runs that followed. Stepping out of the market at the wrong time makes it incredibly difficult to catch back up. Missing just a handful of strong market days can dramatically limit long-term results. But the risk isn't just about missing returns. For retirees especially, there's another major concern: the possibility that a portfolio has become so conservative that it no longer keeps pace with inflation. When your savings aren't growing fast enough to match rising prices, you increase the risk of outliving your money, something no one wants to experience. And here's another challenge. Many people don't even realize their portfolio has quietly drifted into an overly conservative position. Maybe everything is held inside a 401k. Maybe the allocation was set years ago and never revisited. Maybe someone has never worked with a financial professional before. Over time, without meaning to, the portfolio becomes more conservative than they ever intended. The good news is that this isn't a permanent condition. Once you recognize the signs, there are several strategies that can help bring things back into balance. But before we get into how to fix it, let's talk about one of the most common signs: a large cash pile. Now, having some cash absolutely makes sense. Everyone needs liquidity for unexpected expenses, but too much cash can be a problem. Cash is often not king in retirement the way people assume. When someone holds a large amount of money on the sidelines, what we might call dry powder, waiting for the right moment to get back into the market, that's often a red flag. And I hear this all the time: I'm waiting for tariffs to settle, or I'll jump back in when things calm down. But here's the truth: returns don't come from avoiding volatility. They come from managing through it. Sitting in cash can feel safe, but over time, you risk missing the very growth that supports you during retirement. And the market doesn't send out a memo announcing the perfect re-entry point. The article points out that investors may be better off buying when a stock is down and holding it for the long term. Even in retirement, you still have years ahead of you, years that allow investments time to recover and continue growing. The goal isn't to avoid ups and downs altogether, but to have a strategy that can weather them. Another major challenge for overly conservative investors is missing out on the market's strongest days. Over the past 3 years, the S&P 500, the NASDAQ, and the Dow have each hit record highs, and 2025 is shaping up to be another strong year. That's great news for stock investors, but people who shifted heavily into cash, bonds, treasuries, or CDs, all of which had lower returns, may have missed out. The difference this makes over time can be striking. For example, imagine an investor who put $100,000 to work over the past 20 years, ending in 2024. If that money was held in bonds, it might have grown to around $185,000. but if it was invested in a large cap core stock, it could have grown to roughly $844,000. Same money, same time period, very different outcomes. And here's the important part. The risk of being too conservative doesn't always feel like risk. It feels safe until you see what you might have missed. That's why diversification plays such a crucial role. You want to mix assets that don't all behave the same way at the same time. Think about a garden. You wouldn't want everything to bloom on the same day and then fade on the same day. With investing, you want different asset classes flourishing at different times, creating a healthier long-term picture. It's all about balance, not extremes. Now let's talk about inflation, which can quietly reshape someone's entire retirement. If inflation is running at 3% and your investments aren't keeping pace, that's a clear sign the portfolio may be too conservative. The article points out that if nothing changes, whether it's your lifestyle or your asset allocation, you could be setting yourself up for the possibility of running out of money. To put that into perspective, imagine you start with $100,000. At 3% inflation, after 25 years, that money only buys about $47,760 worth of goods and services, losing more than half its purchasing power. And during periods like the years after the pandemic, when inflation hit around 8%, the erosion is even more dramatic. Over 25 years at that rate, you'd lose about 85% of your purchasing power. That's the kind of pressure that inflation can put on a portfolio that isn't growing fast enough. Now, if you're listening to this and thinking, I might be playing it too safe, you're not alone, and it's completely normal. Taking on more risk can feel uncomfortable, especially when you've worked so hard to build the savings you have. But making your portfolio even slightly less conservative may be easier than you think, and baby steps are absolutely okay. A baby step might simply be reviewing your portfolio this month. It might mean making a small shift in your asset allocation next month. These gradual changes can help you realign your portfolio without feeling like you're leaping into uncertainty. Sometimes just understanding that you've become too conservative and recognizing the implications of staying that way is enough to motivate a calculated move when you're ready. Let's shift to what you can do to correct an overly conservative portfolio. One of the best tools available is diversification, and that's true diversification. That means taking time to review your current mix. The end of the year is a perfect moment to do that kind of financial maintenance. And if you've never worked with a financial professional before, this might be the right time to consider it. Yes, there's a cost, but if guidance helps keep your portfolio aligned with your goals, it may be worth it. The article also highlights several signs your portfolio might not be diversified. For example, fewer than 10 individual stocks, a heavy tilt to one asset class, such as bonds, your portfolio reacting dramatically to single company news, overlapping funds, no international exposure, or everything clustered in one sector. These patterns can make a portfolio appear diversified on paper when, in reality, it's not. Another helpful strategy is creating a withdrawal plan in retirement, a strategy that covers essential expenses and allows the remainder of your portfolio to continue growing. One approach highlighted in the article is called flooring, which involves creating a solid base of income that covers your monthly essentials like housing, healthcare, insurance, transportation, food, and personal needs. Once those essentials are covered, the remaining assets can stay invested for growth. This foundation often provides a sense of emotional comfort, making it easier to stay invested through market fluctuations. A similar concept is the bucket strategy, which divides your retirement savings into short-term, 1 to 4 years, medium-term, 5 to 10 years, and long-term, 10-30 years, buckets. Each bucket has a specific purpose and risk level, helping you manage near-term needs while still allowing long-term funds to grow. Many retirees find that this structure brings clarity to their planning. They know which dollars are for today, which are for the next decade, and which are for the long haul. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.